in terms of just the sheer volumes. And if you take a look at the very top edge of this, you'll see this huge lean that we've got at that top edge there for 1,152 lots. Absolutely enormous, isn't it? Absolutely enormous. And you can see exactly how the market traded post that big lean. You can see that we got a reasonable response. And when you look at that chart, I mean, you're thinking 37.90s down to 37.60s. It's $1,500 per contract. It's a pretty meaty old sell-off, isn't it? And bonds have been a little bit crazy today as well. We wouldn't expect otherwise, would we? I don't know who's been buying bonds with me, but we've really just been buying bonds a lot today, but then we got the non-farm payrolls and it set up the whole trade again for a second time. And well, let's take a look and see what the non-farm payrolls did to this bad boy, because this is how it was setting up. If you look at the, I'll take it up a couple of time frames actually, because I've got it right down in the lower time frame charts here. So you can see how this was setting up by going into non-farms. You can see that the overall shape was, you can see it from last night. I mean, you can see where the trade set off, the very, very big trade set off from yesterday. We had this 2s5s that needed to be bought. Simple as that. Very, very obvious trade against the rest of the curve. And you can see that that bottom edge was enormous for a buy trade, and that set off the big popper in the overnight session, in the afternoon session, and the evening session. Well, it became quite obvious how the trade was evolving in this phase here. So in the morning session, of course, having looked at the setups, there was plenty of setups. I was selling the 2s5s into this in the morning session from here. You can see with the drift off on the 2s, the drift off on the 5s, 10s, you can see that for me personally, the trade seemed to be predominantly working these orders up here, trying to work basically a line that we've got on the charts here. Now, one of the things that happened was we started to get this turn up on the 5s, 10s. We started to get some serious bids coming back in on the 5s, 10s that's stopping us doing what we need to do on the 2s, 5s. Eventually, we turned back down. We got the high on the 2s, 5s, gave us another opportunity to buy bonds at lower prints in there. And then we started to see this hold still in place as we were coming in. Take a look at what was happening before the non-farm payroll. 2s, 5s are starting to rock to the upside, aren't they? So the bond traders have a sense of something pending here, don't they? Somebody somewhere is looking at this and saying, you know what the hell is this all about? Why are we running a steepener into this phase? That's bearish. That's going to be bearish bonds, I think, by the looks of it, right? So somebody's got an idea that we're going to be getting a bearish bond response, as we run through the this little phase here. And obviously it's got that look about it. I mean, if you just look at that since 11 o'clock here, you can see that we are in a steepener. Well, if you're in a steepener, what kind of trade should you be doing on bonds? You should be selling top line, right? How do you trade a steepener, guys? How do you trade a steepener on the ultra bond? You sell top line bonds. So was there a top edge that we could sell into? Well, of course there was. There was a couple of pullbacks that were available right through that whole phase into around about 185.20s, 185.24s, wasn't there? So you'll be able to recognize exactly what was diddling on the bond at that stage. You'll be able to look at that and say, yep, can see it, know exactly what's happening in the trade. Here's the bond itself. And there it is right there. There's the setup. And you can see from the tape, you can see from the order flow, that as we were coming into the non-farm payroll release, the bond price had actually moved into what looks almost and feels like a bull steepener. Well, we know bull steepeners are all wrong, correct? For this type of market just now, we know bull steepeners are fundamentally flawed. Well, if we know bull steepeners are fundamentally flawed, we know that if we've got one, we can do something about it. Now, what happened, of course, was we had a a bit of a bull coming in the book here. And that bull that came in the book, of course, should be matched by price coming in there, shouldn't it? And that's exactly what happens. The price gets matched. But this bull doesn't stick around. Look. If I draw that line, it cuts off all the pins to the downside, doesn't it? So from that point onwards, we should be looking at that saying, okay, well, overall, we should be working back into this type of narrative according to the book itself. So not only do we have a bull steepener, we also have a book that's suggesting sell-side liquidity coming in, which we should now be paying very, very close attention to. And obviously what happened was the numbers came out and we got this quite dramatic spike on the 2s, 5s that you would have expected to see, because if you look back on this, guys, I mean, if we zoom out in this a little bit, you'll see exactly that the 2s, 5s is underperforming. Now, you might want to look at it from the 10s, 30s, but obviously that's the 10s, 30s had been dropping off for ages at this stage. You know, so we're already aware of the 10s, 30s weakness. So it's not that I'm paying attention to. I'm paying attention to this, very close attention to this run into the non-farm payroll release. And obviously what happens is we get this change of opinion here right into the actual release itself. And obviously almost immediately we start seeing opportunities to flip this trade over, don't we? We immediately see the opportunity to flip the trade because we already know that the 10s, 30s weakness is dominating the back end of the curve. So we know that this weakness that starts showing up on the 2s, 5s with the strength that's on the 2s, 5s against the weakness that's starting to show up on the 5s, 10s represents a bullish buying opportunity at the bottom edge post non-farm. And that's what happens down at the bottom edge down here. We start seeing buys coming in the book. We start looking at it from a buy side point of view down in these areas as we go into that spike right there. If we overlay that with the ultra bond, you'll be able to recognize exactly where that trade is. You can start watching that trade as it evolves, can't you? If you look at it from the ultra bond, that top edge there on the 2s, 5s is the bottom edge on the ultra bond right there. And that's exactly what the trade becomes. You're starting to buy the bond off the lows after the non-farm payrolls comes out. That was a price of 184.04s. That trade traded 186s by the time we got to the top print price before the first pullback. Since then, it's traded massively higher to 187s for nearly $3,000. Nearly $3,000 of upside. Did anybody not know we were going to be buying bonds? Well, let's think about it. Did anybody not know we were going to be buying bonds when you saw this amount of weakness on the 10s, 30s, guys? What do you think? Was everybody not just waiting for the weakness in the 5s, 10s? Reeve, tell me, Reeve. Tell me, Nessie. Tell me, Rennie, were you not just waiting for the weakness on the 5s, 10s to start smashing those long bonds? Because we've already got the 10s, 30s weakness. We're just waiting on the 5s, 10s weakness to show up, right? Well, the 5-10's weakness showed up twice. It showed up here today when we bought bonds in the London session, and then it showed up a second time just post non-farm payroll. Right here, it showed up a second time post non-farm payroll. And that's when we got the second series of buy opportunities. And that's all we've been doing. And since then, the trade's actually still developing a beautiful, beautiful look about it. And every single one of these trades here, every single one of these trades has had an opportunity to smash more into the long side of bonds, all literally the whole way through this process, guys. Long bonds, top edge, long bonds, long bonds, long bonds, long bonds. The whole morning is just a whole US morning has just been long bonds for me since the non-farms. I can't believe how good it's been, to be honest, guys. And I hope you've all seen it. I hope you've all got it. I hope you've all managed to really see exactly why that's taken place, guys. It's been beautiful. One of the things we were talking about yesterday as well was the TED spread. We were trying to get you guys to think about the TED spread as well, and think about how the TED spread evolves and what the TED spread does, and just remind you of the value that having the TED spread available to you can provide you with. You know, so I'm sure I had the TED spread on one of these. So yesterday I showed this. I showed this to everybody. I can't remember who I was. I don't think I was having a conversation with anybody. I think I was just babbling on about random stuff. But we'd actually already talked about the TED spread. Let me just change it from the ultra 10 to the ultra bond actually, because that would make a wee bit more sense since everybody trades that one. So this is what we were showing yesterday, was the TED spread against the bonds here. Now, what is the TED spread? It's something that obviously we're going to lose in due course come 2023 when they whittle away at the LIBOR rate, isn't it? But obviously it's going to be the SOFR going forward. But SOFR and LIBOR is not going to give us the same sensitivities on this one, and it's a bit of a pity because it's been an absolute lean against line for decades, literally. And it's this relationship between LIBOR and risk-free. In other words, it's bank liquidity. That's basically what the TED spread is how much liquidity is in the banking system. The difference between the rates that's paid between the banks and otherwise. And you can see there, if we look at the TED spread, it really shows liquidity. Now I've got it set up as a positive correlation. So in other words, if we read it from a liquidity perspective, if this line is dropping, that suggests that the banking sector is in good condition. It's in a good condition. There's a lot of liquidity available for banks to borrow against, borrow from other banks. They're not having to pay the big rates. That's a good thing, and that's going to lead to some selling of bonds. There's going to be some selling of bonds. Money's flowing quite nicely, quite easily. So when we see this dropping like this, generally as a rule, we should be able to make money selling bonds, and that was yesterday's bond trade right through the morning session. You can see it right through the morning session, right into the US Open. We had this very, very obvious weakness coming in from the top edge, allowing us to sell lots of bonds against that good-looking liquidity situation. You can see that stays in place. If we zoom in or zoom out, that liquidity position stays in place literally right through the morning session. Into the low price here of the overnight session, you can see it starts to just diverge just a little bit after this fall through here. Now, obviously, as we move into this afternoon session, you'll be able to recognize, first of all, that there was a big buy in the markets here. Now, it obviously had dropped down a little bit ahead of that number. But you can see that in terms of macro narratives, there's still a very sizable size available for people to buy into this little fella here. You can see, actually, the TED is going back up again, allowing you, if you wanted to bid into that bottom edge, to go ahead and do so, because this should be a very strong positive correlation, and anytime you see the candles going in the opposite direction from the line itself, you're probably going to find opportunities, right? You're probably going to find opportunities to do a bit of business. Well, that's what's happened, isn't it? That's ultimately how this has developed and how it's evolved and everything else. I mean, it's turned into be an unbelievably good trade. However, it's starting to get a little bit tired at the top edge. So that's something that you've got to just be aware of, guys. Now that this has ran its course, just be aware that the TED is now suggesting, if we go back now into the background, you'll see that we have a little bit of an area here in the crosshairs, which has a fairly substantial bank liquidity divergence, suggesting that there's maybe going to be some opportunities to sell some of these higher prints on the bond. So just be watching for the offers coming in the book. Now, at the moment, the book still seems to me very, very strong. The liquidity still looks pretty good. And as I said, from the perspective of the 2s, 5s, 10s, it's a tough shout to be able to say we're going to start selling bonds anytime soon. So I'm not a mad fan of it right yet, because I need to see it developing on these two fronts at the moment, and I don't see it developing on these two fronts. But don't be scared to buy into downticks, but make sure that around that 187 for the time being, make sure you go ahead and take some of the cash off the table, because there is definitely other aspects to this trade that are bubbling away in the background that could cause this to just come back around a little bit. So just bear that in mind, guys, around the 187s.